Hello everyone, welcome to my channel. Today I'm going to talk about gross income versus net income. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribe. I will try to personally reply to your comments. Let's get into the video. The two most essential indicators of a company's profitability are gross income and net income. After manufacturing expenses have been deducted from revenue, gross profit is the residual money or profit. The amount of money earned from the sale of a company's goods and services is referred to as revenue. Investors use gross profit to calculate how much money a business produces from the production and selling of its goods and services. The words gross profit and gross income are sometimes confused. The profit left over after all the expenses and costs have been removed from revenue is known as net income. Net income or net profit is used by investors to measure a company's entire profitability, which indicates how well it has been managed. Investors can determine if a company is successfully and if not, where it is losing money by understanding the difference between gross profit and net income. Gross profit, operational profit, and net profit are all terms used to describe a company's earnings. On the other hand, each one represents profit at different stages of the production and profit process. Gross profit refers to a company's earnings after deducting the cost of producing and selling its products, also known as the cost of goods sold. Gross profit indicates how well a company controls its production costs, such as labor and supplies, to create income from the sale of its goods and services. The gross profit of a corporation is calculated by subtracting total revenue from cost of goods sold for the accounting period. Revenue refers to the entire amount of money collected from sales for a specific time period, such as a quarter. Revenue is frequently referred to as net sales because it may include discounts and deductions from returns or damaged merchandise. Net sales are widely reported as a revenue number by companies in the retail business. For example, the cost of merchandise returned by customers is deducted from the total revenue. Revenue is sometimes referred to as the top line figure since it appears at the top of the income statement. The direct cost of making a company's goods are referred to as the cost of goods sold. Direct materials, such as raw materials and inventory, are often included in cost of goods sold. Direct labor, such as production workers' wage, production-related equipment costs, repair cost of equipment, utilities in manufacturing plants, transportation costs. As we can see from the cost of goods sold categories, variable costs or costs that vary depending on production output make up the majority of gross profit. Fixed costs, which are expenses that are incurred independently of production output, are usually excluded from gross profit. Fixed costs include salary for the corporate office, rent, and insurance. Some businesses, however, employ absorption costing to allocate a portion of their fixed manufacturing costs to each unit produced. Gross profit is calculated by subtracting revenue or net sales from a company's cost of goods sold. Gross profit and net profit are both included in the income statement. The revenue and cost of goods sold lines are above the gross profit line. Net income is found at the bottom of the income statement since all expenses and costs have been deducted from revenue. Net income is a term used to describe a company's earning for a given accounting period. In other words, net income is the sum of the company cost and expenses after revenue has been deducted. Net income is usually referred to as the bottom line because it's found at the bottom of the income statement. Debt and loan interest, operating costs, overhead, selling, general and administrative expenses, individual income taxes. Depreciation is the cost of fixed assets such as equipment that is spread out over its useful life or expected lifespan. Additional sources of income are frequently included in net income. Companies, for example, commonly invest their capital in income assets, which are assets that are held for a short period of time. Profits from asset sales are also considered income. Net income is computed by subtracting all expenses and costs from revenue and adding money from other sources. Depending on the business, a company may have multiple sources of income in addition to revenue and numerous types of expenses. Some of the income sources or costs could be listed as separate line items on the income statement. The cost of goods of a manufacturing firm, for example, would almost surely be included, whereas the expenditures of a service company would almost certainly be recorded under operating expenses rather than cost of goods sold. The general formula for calculating net income is total revenue minus total expenses equals net income. A more detailed formula would be net income is calculated as gross profit minus operating expenses minus operating business expenses minus taxes minus interest on debt plus other income. Gross profit is a metric that measures a company's capacity to earn a profit while managing its production and labor costs. As a result, it is a vital metric in determining whether a company's earnings are increasing or dropping by looking at sales, production costs, labor costs, and productivity. If a corporation reports a gain in revenue that is more than offset by an increase in production expenses, such as labor, the gross profit for that period will be lower. If a corporation hires too few production workers during peak season, for example, present employees will be obligated to work longer hours. The effect would be higher labor costs and a drop in gross profit. Using gross profit as a criterion for total profitability, on the other hand, is errors since it ignores all of the additional costs that come with running a successful business. The profit earned from all sectors of a company's operation, on the other hand, is referred to as net income. As a result, net income is more comprehensive than gross profit and can be reflected the management team's success. For example, a company may increase its gross profit while mismanaging its debt by borrowing too much. Despite the company's great sales and production efforts, the increased interest expense for repaying the debt may result in a net income loss. Thanks for watching this video and do not forget to subscribe to my channel.